Stocks trade weak with mid-caps bearing the brunt, reflecting in a high declines to advances ratio. PSU banks, healthcare and IT are the big drags, with energy being a rare gainer.
Revenue Secretary Arvind Srivastava tells CNBC-TV18 that the hike in STT was motivated by an intent to curb excessive speculations in the F&O segment. Market players, however, wish the mop-up was used to offer tax relief to long-term investors.
DIPAM Secretary Arunesh Chawla is confident of meeting the government's divestment target via a mix of asset and PSU land monetization along with traditional divestment. He says the government is also open to considering less than 51% stake in PSUs as suggested by the Economic Survey.
Automobile sales in January show sustained momentum following the GST rate cut, with most players reporting double-digit sales growth from SUVs to tractors to CVs to two-wheelers. The pace is healthy all around.
Hello and welcome to Halftime Report on CNBC-TV18. I'm Ekta Batra. With me is Sonal as well as Vinny. Well, it's turning out to definitely be a very choppy session for the markets, and the broader markets are not faring any better in today's trading session. So we have the mid-cap index, which has recovered from the day's low, but still down around 0.8%. We have an advanced decline ratio, which is extremely dismal at this point in time. And the Nifty, which is just about flitting between red and green, undecided in terms of the direction that it wants to go. So the low point of the day was 24,679 for the Nifty, and the high point of the day was around 24,943, to give you a sense in terms of the kind of volatility and range that we've seen in today's trading session. But let's see more of the details in terms of stocks coming out through the day. So that's what we're going to be looking at in today's trading session as well. Vinny, Sonal, hi.
Hi, good afternoon. So absolutely, a lot that we'll watch out in terms of stocks, but a choppy trading session like you mentioned as well. And in terms of sectors today, we're seeing continued pressure come in for metals, pharma, media, not doing well in the trading session. What's managing to hold on to some bit of a gain today is the auto pack. We have those auto sales numbers obviously that are coming in as well. We'll watch out for that. But an interesting day of where we're going to be headed in the second half of the trading session. That will be key as well, Sonal.
It will be. Markets continue to be on our radar. And that STT increase that came by on F&O is something that spooked the street as well, though the recovery is underway. So while we are talking about this F&O tax hike impacting the stock markets, there is another impact as well, and that is on arbitrage funds. Now, do remember, arbitrage funds are a type of hybrid funds. They do have exposure to F&O as well. And a lot of these funds have massive positions in the F&O space as well. And that's the reason this hike that has come by in securities transaction tax is something which could impact returns for investors, because fund managers book profits by leveraging the price difference between the current and the future markets, the cash and the futures market, that is. And that is the reason why these funds will be in focus. Now, do remember the yields on these funds usually is anywhere between 6 to 7%. However, if we talk about some calculations, because every fund will have a different exposure to the futures market, so depending on that, the impact on returns will be 0.3 to 0.5%. This is a short-term asset class where investors can park their money for a shorter period of time. And this was a category which a lot of investors were looking at from a short-term period because they have a better taxation structure. They are taxed as equity, while liquid funds are taxed as debt. So there was a differential of 1 to 2% in terms of returns as well post-tax. So now that differential comes down. But yes, still, arbitrage funds are better when it comes from a taxation perspective. But yes, the returns could be a little bit lower. And that is what is the takeaway from this STT hike that has come by.
Okay, all right. But we have a whole host of questions to ask our guests. We have Varun Lochab, who's the head institutional research at HDFC Securities, who's joining in now. Varun, hi, welcome to the show. Well, it's turning out to be a choppy session, but let's start with that discussion on STT. And what do you think is going to be the impact on companies such as, say, Angel One, Grow? Do you think it's going to have a significant impact in terms of volumes for them and your overall sense?
Yeah, hi, good afternoon. That was clearly a dampener from a sentiment perspective, the STT rate hike, because I think most of the market participants were not expecting it. But at the same time, having analyzed the impact, we don't think the exchanges or, even the broking companies will have a significant negative impact. If you see in the past, when STT increases happened, frankly, that did not dampen the trading activity to that extent. I think it's the other factors, your outlook on the market and, the overall mood of the market, which impacts the trading volumes far more than, STT per se. So we don't see a very significant impact. And especially in case of BSC, like, which is a company under our coverage, they don't have much exposure on futures where, the increase has been sharper. So they won't be impacted much. And similarly, Angel One also, from our coverage perspective, we don't see a significant material impact because of this STT hike, on their trading volumes.
Okay, so your outlook overall for maybe all these capital market names continues to be positive going forward as well, short term or medium term?
Yeah, so we have been quite positive on this space. Both BSC and MCX have been our topics for quite some time. MCX, we continue to run as our topic across our model portfolio as well. And we are very comfortable holding some of these names from a medium-term perspective.
Varun, the other change that has come by is in the buyback taxation. And since the time from 2024, it was changed as being taxed like a dividend income. The companies were not going ahead and putting out so many buyback offers, right? Do you think now that trend could come back? And the higher tax rates that's come from promoters, what do you make of this? And IT space is one which sees the most amount of buybacks. How do you read this change?
I think overall it's a very welcome change, a very positive move, to kind of tax them on the lines of capital gains instead of and more so I think in with markets in a correction phase over last 12 to 18 months, hopefully more companies will be starting to do buybacks if the valuations start getting attractive and the froth is coming out. So from a timing perspective also we believe it's timed well because hopefully we'll see more buybacks in the next 12, 18 months than what we saw during 2023 or 2024 sort of a time period. So a very good move and, a very welcome and positive move for the companies.
Well, it seems as though the froth is definitely coming off for silver and gold at this point in time, Varun. I'm sure a lot of investors are probably asking about what they should do in terms of their holdings when it comes to precious metals separately, or maybe the ETFs where they have positions as well. What is your recommendation?
See, like we cover more on equities, but from a HSL perspective, our overall house, had turned a bit cautious on, gold and silver, especially towards the end of the year and early part of Jan, because the move was really, too fast. Even though we were expecting precious metals to do well at the start of the calendar year, first 20 days of, this calendar year itself was sort of return which we had not expected. So we had turned cautious, on these precious metals. And I think it's more like a speculative unwinding, which is probably leading it to sort of, overreaction even on the downside, just the way we overreacted on the upside. So I think from a medium or long-term perspective, one should not be changing their asset allocation significantly. We have been saying that 10 to 15% exposure to precious metals in your multi-cap portfolio, one should continue, and ideally one should have rebalanced at a very sharp increase, which we had seen, gold to Nifty or, silver to Nifty sort of ratios were really off chart. And I think that is correcting now.
Okay, Varun, thank you so much for joining us this afternoon, giving us a view on the markets as well as even in terms of gold and silver, 10 to 15%. Keep your asset allocation for the long term. But on that note, we're going to slip into a very short break. Up next, we will connect with the management of Sun Pharma to decode their Q3 numbers. Stay tuned in for that conversation.
Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Well, Sun Pharma reported what was a strong set of Q3 numbers, with their revenue, in fact, growing this quarter at around 13% and margins also expanding. I did catch up with the management of Sun Pharma and began by asking about the budget announcement of the 10,000 crore outlay when it comes to biologics. Listen in.
This is a welcome move by the Indian government. It's a step in the right direction, and I believe that it will give a big boost for the India's biological space. Funding of the R&D, better clinical trials and infrastructure, getting faster approvals are all going to be good from an overall perspective, and it will help us to stay competitive in the high-value therapies. We do expect more to come in. And with government and the pharma companies working together, this could be a very interesting space for us to be in.
Okay. All right. Well, before we get to the numbers, Ms. Jayashree, I wanted to basically quiz you on the big market speculation which has been doing the rounds for Sun Pharma, which is the potential $10 to $14 billion Organon acquisition. Your comments on whether you've thrown your hat in the ring when it comes to this acquisition?
Look, we have clarified our stand on this. We do not respond to market speculations.
Okay. But can you comment at least on whether or not a deal of this size fits your strategy as a company?
We do not respond to market speculations.
Okay. But in terms of M&A strategy, if you could just surprise us of what the company is thinking on M&A.
We continuously scan the market for opportunities. Our capital allocation priority remains the same, with our primary allocation which goes towards the innovative medicine business. We have looked at emerging markets, and we will look at it on an opportunistic basis as well. Our strategy hasn't changed.
But would the US be a priority market considering the push towards onshoring?
Yeah, US continues to be a priority market for us. We have a large presence there.
Okay. There are talks of you might be looking at Brazil as well. Would you like to comment on that?
Not really.
Okay. All right. Well, I tried my best there. But if you could now just, sort of narrow down on the FY26 guidance. You had guided for mid to high single digits plus $100 million in terms of specialty investment. Is this on track?
I think our results for the past 3 quarters have come out well. We would continue to focus on performing to our potential, and we believe that we will end the year towards the higher end of the guidance.
Okay. Anything that you can apprise us of when it comes to the innovative medicines portfolio, which came in at around $380 million this quarter? Estimates were $365 to $367 million. So you did better on that front. Should investors now model in maybe high single-digit or low double-digit growth when it comes to the specialty business or the innovative medicines business on a sustainable run rate?
I can tell you that our innovative medicines business has been growing pretty steadily, both in the US and across the other geographies where we have presence for innovative medicines. We will continue to focus on further growing these.
All right. The big question is semaglutide in Canada. Where do you stand for that?
Currently, our focus is on launching the product in India.
Okay, but you've applied for the approval in Canada, correct?
Yes, we have applied for the approvals in Canada, and as and when we get the approvals, we will be in a position to talk further on this.
But any timeline?
I do not have a timeline at this point in time.
All right. About India, it's expected to be a very competitive market. What are you expecting from semaglutide here?
As far as semaglutide is concerned, Sun, as you know, is a market leader when it comes to cardiometabolic segment.
Yeah.
We have approvals for both chronic weight management as well as type 2 diabetics. and we have approvals in all the 5 strengths. Both our new products, Novel Treat and Smart Trinity, will be dispensed in easy-to-use formats. And we are all pretty excited about launching the product on day 1.
All right. What about maybe launches in other emerging markets for semaglutide?
We do not have much to comment at this point in time.
All right. What's your outlook for the US business, considering that, Revlimid generic, the opportunity is now dwindled? We do have pricing pressure, which companies are also facing. What can we expect in terms of guidance for the US?
So US is interesting for us with both innovative medicines as well as generics. On the generics, we've been seeing a price erosion over the years, and that situation would continue to happen. We have our set of products which we will be marketing in the US. At the same time, as and when our facilities, the manufacturing facilities are coming out of the compliance regulatory requirement, we will be ready to launch new products for the US market.
Okay. And if you could just end by giving us a guidance in terms of what the status of the plants Halol, Baska as well as Mohali would be, and what are the timelines in terms of what the street could probably expect in terms of remediation?
So we are working on putting together the actions. Once we have the FDA come in and look at our facilities, we will be in a position to further comment.
Okay, all right. That's the one word coming in from Sun Pharma. But with that, we'll slip into a short break. When we come back, Vivek will take us through the stocks that are moving around in trade today. Stay tuned for that.
Welcome back to Halftime Report on CNBC-TV18. As of now, the Nifty is at 24,896, almost near the day's highest point. We'll wait out for where it's going, up 70 points in the trading session as of now. But a lot of stocks that are moving around in the trading session. Why are they moving around? Let's go across to Vivek to give us that list. Good afternoon, Vivek.
Well, good afternoon. So much volatility in the markets, especially in the first 3 hours of the trading session on the day immediately after the budget. Well, the first stock on our list today that's moving quite sharply higher is Reliance Industries, a sharp up mover leading the index higher. Remember, it's a heavyweight, over 2% higher on good volumes today. Tata Motors passenger vehicle, very good set of numbers coming in as far as the monthly sales was concerned. That stock, the top gainer on the Nifty today. Paytm cooled off a little bit from the day's highest point, but this particular stock, opened sharply gap up. Again, higher UPI incentives is something that the street is looking at quite positively. Two names, from the real estate pack seen benefiting from increased data center tax relief. Both Anantraj as well as Lodha developers today higher by over 2.5% and 3% respectively. And the entire OMC pack, HPCL, BPCL, IOCL, clarification coming in that there is no excess excise duty is something that the street is taking quite positively. On the other hand, quite a few laggards as well. The entire metal pack continues to languish under pressure today. SAIL, Vedanta, JSPL, all of these stocks under pressure. The entire NBFC basket, hardening yields is something not seen very positively as far as NIMs are concerned. Most of the NBFC names like Shriram Fin, Chola Fin, LIC Housing Finance, all of them under significant pressure. Intellect Design Arena, one name from the broad end of the markets, continues to fall under after week Q3. This particular stock down over 7% on high volumes. And Glenmark Pharma, worries of a GST inspection on the stock is something that is leading to quite a bit of a sharp sell-off, over 4% lower for Glenmark today.
Okay, some interesting names there. Thank you so much for getting us the individual names which are buzzing around in trade, Vivek. And with that, it's time for another break. On the other side, Manisha Gupta will join with Sabyasachi Ray of Gem and Jewelry Export Promotion Council. This will be our What's Trending segment. Stay tuned for that conversation.
Welcome back. Well, it's a volatile day for the equity markets, but let's focus on our What's Trending segment today, and it has to be gold and silver prices. Gold and silver ETFs, they remain under pressure as bullion prices have extended their decline for a third consecutive session. Gold has seen its biggest single-day plunge in over a decade, while silver has also seen its sharpest fall on record. As a result, we have gold prices which have slipped below $4,550 and silver which is now trading below $74 at just about those prices. The sharp correction is weighing on precious metal ETFs, with investors now reassessing possible positions amid this heightened volatility. Well, let's listen in to S. Naren. He's the veteran investor and ICICI Prudential AMC's ED and CIO. He sounds caution on the precious metals rally and advises against investing in commodities. We'll also go to Manisha Gupta, our commodities editor, for more on our What's Trending segment. Let's start with S. Naren and what he had to say.
Over the recent past, we have been continuously telling people don't invest standalone in precious metal ETFs or fund of funds. Focus only on multi-asset so that you're not investing big money in precious metals at this point of time. A framework that we have is that whenever any asset class gives you triple-digit return, that is more than 100% return, that in a year, you have to be careful in that asset class. And that asset class is silver at this point of time. So that's what we've been trying to do, but people want us to guess correctly an asset class which can never be guessed correctly, because you see the daily moves in silver, you know it is impossible.
Well, yes, nobody could have said it better, by the way, because the kind of moves that we had started to see, the overheated froth in the market, clearly perhaps had to end this way. So I just want to take you through prices right now. That is gold international prices for you. Well, remember, the international all-time high has been 5,600. We are trading at 4,500. So that is $1,000 per ounce of a decline in a matter of 2 or 3 trading sessions there. Very, very sharp cuts coming in. Even on your screens right now, it is 7% down. Take a look at the silver prices, 12% of a decline. This comes in on the back of 37% decline that we saw on Friday. So the all-time high that you have seen for silver is $121 an ounce. In the morning when I was making all those demarcations, if you were still trading on the higher side, currently we are just about holding $70 an ounce. I mean, that's nearly 50% of a correction that we already have seen come in for the silver prices. And that's not just 2 of those commodities. If you look at platinum, palladium, in a matter of last 5 or 6 trading sessions, we have seen a decline of 25 to 28%. Copper has seen a decline of 11% from its all-time highs, and the list perhaps can go on because this is big profit-taking, a sell-off that we are seeing coming in case of commodities. Crude is down 5 to 6% at these levels right now, so we're looking at quite a bit of a sell-off coming in for commodities there. But what does this really mean for the overall sector going forward? To get that conversation in, we are now joined by Sabyasachi Ray. He's ED at GJPC. Sabya, thank you so much for joining in. And I know we've been talking to you about global cues and trade agreements and tariffs, but the volatility is something that we have to, address as well. The gains that we saw into the markets were disturbing, and we kept talking about on how it could impact the jewelry as a segment. But the kind of decline that we have seen also, how are you reading it as a council, as a segment?
Manisha, thank you. One of the things, Manisha, when we were conversing, I always used to tell that I do not want to be part of this conversation around the price of gold and silver. Because when there is no explanation into the growth is natural because you are the one who every day you are tracking it. When we originally started maybe last year, then we were all understanding that a lot of investments is coming to gold because of the gradual price of gold and silver. The way, its usage has expanded based on the price increase is normal. And it was going through a gradual improvement, let's say 20, 30%, 40%, whatever it was going through. That was a bit of a normal. But then in the recent times, what has happened, you are just showing in your screen only from January 1 to the record high. That is somewhere I think that it was beyond any type of explanation or any type of outlook what we can take. Because of that, we remained silent. And wherever it is going at, as an industry, I can tell you that we are not that unhappy because we all understood, and it was also coming through your channel in newspapers also, that it was going to an unsustainable price for the buyers of jewelry. So that it should go to a sustainable price levels, that if it goes there, you are showing the levels of January 1 and etc., we should be very happy. However, the type of growth it has seen and the type of decline in the last 3 days, only this type of decline is happening. It has its own pitfalls. Whoever has invested heavily, etc., they have their own loss making, etc. In India, at least, it may spell disaster on certain, maybe certain units or etc. That is a bit of concern. But generally, if the prices are as per the explainable levels, we're happy. And if it goes somewhere around January 1 level, that will be happy. But yes, of course, that's right. That time also a lot of people are telling the prices increasing before profit booking. And now it is going to the levels where it should be there. This much I can tell you at this point of time.
All right. Sabya, when I look at 2025, and this is as per the World Gold Council report, 2025 saw record investment in gold. Jewelry buying in 2025 has seen a bit of a decline. With this price correction, whether it's about the Indian markets, international exports as well, do you see once the prices stabilize at fair levels, we could be looking at business coming back?
See, the business is always there. Manisha, one of the things this is only stalling of the buying. That's all. This all need to understand that there is no dearth of business or no dearth of the affinity of the consumers in terms of buying of jewelry. It is only the term of stalling, and only it is outpacing their income growth. That is the thing what is of a concern. So that will be a good thing, that if it again comes back to the levels where the consumers will find it attractive to buy in terms of buying of jewelry. In terms of investment, yes, investment will suffer a hit in the shorter run, because you always invest on this aspiration that it will go up. Now, people will always try to wait for the investors will try to wait when it will find the levels, when they will think that the flow level has reached, and then from here the steady growth in future also based on the demand supply scenario, or demand based on the investment scenario, then of course people. So right at this moment, I do not think that anybody is investing, because everybody is trying to look at where is the floor, what is the flow level. That is one of the issues. And flow level, as you are showing, that in my opinion also, around the January 1 figures, around that should be the flow level, and beyond that can happen. But investments will go on. Gold, the way the type of returns, and it will be a very good commodity to invest upon. The gold and silver, both one.
Sabya, I also want to get your sense on the budget that came in yesterday. Did not talk about gold, silver at all.
No, it has talked about gold and silver. You have to see the fine print of the budget also. Don't go only by what the big ticket things, what the finance minister told. But beyond that, you see that we are seeing a direction. If you see this is the first time what they have come up is that on the gold, doré and other, bullion commodities, they have now given a sunset clause of the duty waiver. This is a big thing. What we understand is that we are still checking and clarifying that the government of India is trying to go into a regime of a total ecosystem of gold. I'll tell you what is the ecosystem. You have a good refinery, you have a good exchange to price determination, etc. All these things. I think that the direction has been already shown. You have already created an exchange. The refining capacity in India has also grown. So why not? You have a market of around some 1,000 tons of demand market here itself for gold. Why not refine your own gold? Why not your gold finds price levels and etc. The way Dubai has done without being a big consumer of gold in that per se. So that way I think the direction is given where the bullion import duties, there is a date which has been fixed. I can tell you exactly it is 31/3/2027. The whatever duty concessions are there, they have given a sunset date. That means, and also you have seen that in recent time IFSC has come with India Good Delivery Standards. The standards, then you can always find your own price mechanism also you can make. So that is one decision has been given already.
Okay, all right, Mr. Ray, Manisha, thank you so much for taking us through this important conversation. That's all we've been talking about, right? The volatility that we've been seeing in some of these precious metals prices. But with that, we'll slip into a short break. When we come back, we'll connect with the management of MedPlus Health Services to discuss their Q3 numbers. Stay tuned for that conversation.
Welcome back. Well, for the markets, the volatility continues at this point in time. In fact, we have the mid-cap index, which is back down around 1% with an advanced decline ratio, which is weak. We have the Nifty, which is just about holding by around 44 odd points. But let's talk about particular companies now. MedPlus is in focus. MedPlus Health reported what was a good set of Q3 numbers. The revenue and the margin did come in quite healthy, and we did have the company which was in focus because it added around 182 stores as well. We have Mr. Reddy, who's the MD and CEO of the company, joining in to discuss the quarter gone by. Mr. Reddy, thanks very much for taking the time out. Well, you know, what stood out was your same-store sales growth in your stores which have 12-month plus on them. It was double digits for the first time since Q4 of FY24. It was around 10+%. What led to that growth?
A couple of things. We had in the past alluded to a little bit of a constraint on the supply side. Supply side meaning our own ability to move stuff across to all our stores and all, because we had grown too fast. Our warehouses were not completely there. So a lot of that got eased up. It's still work in progress, but I think it'll get better as we go forward. And the second thing, you know, our own, you know, decision to, I wouldn't say step back, but, you know, take the foot off the pedal on the private label medicine side, meant that, you know, the growth came in with the full numbers. You know, if you had continued to grow the private label at the same level, the medicine side, what we normally sell at around 80 or 82 rupees basically comes down to around 40 or 45 after the discount. So that would have basically shown a slight decrease. That we have not done this time. So both those reasons, you know, slightly better logistics management, and also a decision to push forward on the brands and not necessarily continually push the private label, I think probably led to this.
Okay. Mr. Reddy, you have spoken about store expansion, which could add to the growth that Ekta just spoke about right now as well, right? Will you use your entire cash for that, or will you reward shareholders with that? You do have 600 crore rupees in terms of cash right now with you. Will you do it to expand it to 600 stores this fiscal, or will it go in some way to the shareholders as well? Even buyback taxes have become better now for shareholders.
Sure. No, I don't think we'll be giving out a dividend anytime soon. I think there's a lot more growth in the company, but the good news is that, you know, for the kind of growth which we are actually looking at right now, we really don't need to spend any of that cash at all. You know, even if you're going to put in 600 to 1,000 stores a year, it basically costs us less than 250 crores. So we're not going to be dipping into it. And that cash we're anyhow accumulating quarter on quarter, and also I don't think that's going to be a problem. But we want the money in the bank for a slightly faster growth as we go forward. We are looking at franchising as an option, and we are still, you know, trying to iron out some of the things out there in that model. Once that is done, then our growth will become way faster than where we are right now. And I believe, and for that reason, you know, I'd like to keep the money with us at least for a while.
Sure.
We also, by the way, we don't have any loans in the bank at all also. So for us, not only is there cash in the bank to take care of the growth, we could also borrow, but I know that there is a lot more potential for the rate of growth at which we are. We don't need the money, but our intention is to grow much faster at some point of time. So we'd rather keep the cash.
Okay, you'd rather keep the cash. You still see some growth there. Mr. Reddy, you know, you said that you're not focusing much on, you know, pushing too much private label now, and branded is also where you're focusing on. But private label, you managed to see a bit of an increase there, 22% that rose there. Contribution from pharma private label, that's a reduction, right? So overall now going forward, how is this mix going to be changing going forward?
So for us, whatever growth we can get on the general side, that's all added bonus, because normally people don't really look at least they were not looking at us to buy their toothpastes and shampoos and creams and all. Our private label allows us to push that because it is priced very, very attractively. So we are able to get, let's say, a larger share of the wallet of our customers by selling this stuff. So private label pharma on the other side, when we push it, you know, it obviously there's sometimes a little bit of friction. We know it will grow. It continues to grow out there and all. It's not going to stop anytime soon. But Compared to the past, where we are growing really, really rapidly because of a big push from our side, we have decided to slow down on that and only focus on the general goods. Here, there's absolutely no limit to what you can actually grow on the non-pharma side.
Okay. Mr. Reddy, are you on track to hit that 600 store guidance for FY26? Because you've done around 400 for 9 months.
Yeah, given that we did 182 stores this quarter, I think, we'll probably increase it a little bit and then get to that 600. I don't see any problem with that.
Okay. How are you doing on your diagnostic business front? Revenue was up around 19%. Margins seem to have been, better than what you reported the same time last year. Are you now confident about expanding the diagnostics business? Because that is something that you held off on for some time.
We probably require a pivot on that model out there because, for us, I was hoping to get a lot more memberships out there. Profitability was never in question. It was just that we wanted to get a number of around 250 to 300,000 as primary subscribers to our model. We have not achieved that. It doesn't look like we will get to that number that easily without the B2B aspect and all. So I'm going to hold off on that for a while. We're not going to be expanding in the current form, which is going and spending a lot of money on capex in several, expanding would mean spending 100, 120 crores per city. And we would want to expand to 7 or 8 cities. That is not happening because in my mind, at least to us, the model has not been fully proven. It is profitable. That's the good news, but not to the point where we'll go and spend more money. Okay. We will pivot to a different kind of model on that, which is obviously has no capex.
Take that point, Mr. Reddy. Thank you so much for joining us and giving us those honest and clear answers on the strategy going forward. That's the word coming in from MedPlus. Good quarter. They do have sizable cash, but they'll use it for growth going forward and are confident on store addition guidance of 600 stores in FY26 as well. Slip into a short break. When we come back, we'll get you more on the markets and a lot of stock-specific action on the other side. Stay tuned for that.
Welcome back to Halftime Report on CNBC-TV18. As of now, the Nifty is where we started the show with, right, around the 24,900 level, just slightly below that. Oh, it's actually touched that 24,900 level. It's almost in the day's highest point, and 70 points uptick is what we're seeing for the Nifty. I do want to pull up the advanced decline ratio and see where that is as well, because the broader end of the market was not doing too well. That was continuing to underperform. As of now, let's look at the advanced decline ratio of where that is headed in the trading session as well. Mid cap is still down 0.8%. Small cap too is trading with cuts in the trading session as of now as well. Advanced decline ratio still far apart. Declines is far advancing the far more than the advances that we're seeing coming in as well. But yes, that's the market setup for you all. IT continues to be under pressure. Banks down also 0.5% in the trading session. Auto is the only bit of a green that we were seeing on the screen. But with that, we're absolutely out of time on this edition of Halftime Report. Thank you so much for tuning in. Up next, your Business Lunch.